15 tax secrets rich people use and what you can learn from them. In this video, we reveal 15 smart strategies rich people use to reduce their tax bills legally. From offshore accounts to real estate depreciation and charitable loopholes, this isn't about cheating the system, it's about understanding it. Watch until the end for examples and experiments that show how you can start applying these principles to build and protect your wealth. Ever wondered why the ultra-rich seem to pay less tax than the average working person? It's not magic, it's knowledge. Today on The Art of Building Wealth, we're unlocking 15 legal tax strategies the rich use and showing how you can begin thinking like the wealthy. Number 1. Living through LLCs and corporations. Rich people don't own things personally, their companies do. They operate through limited liability companies, LLCs, or S corporations, allowing them to write off business expenses like travel, meals, and even vehicles. If you take a vacation, it's personal, but if your LLC takes you on a business retreat, it's deductible. Number 2. Real estate depreciation. Wealthy investors use real estate depreciation to reduce taxable income even when the property goes up in value. Imagine you buy a house for $500,000. You can deduct 3.6% every year as depreciation, even though the home appreciates. That's $18,000 off your taxable income annually. Number 3. Tax-free borrowing against assets. Instead of selling stocks or real estate, which would trigger capital gains tax, the wealthy borrow against assets. Loans aren't taxable income. Elon Musk used Tesla stock as collateral for loans, tax-free money, legally. Number 4. Capital gains instead of income. Ordinary income, like salary, is taxed higher than long-term capital gains. Rich people structure their income from investments, not wages. Compare $100,000 in salary up to 37% tax. $100,000 in long-term capital gains, 15 to 20%. Number 5. Strategic philanthropy. Donor-advised funds. Rich individuals donate assets into donor-advised funds, DAFs, receiving immediate tax deductions while still controlling how and when the money is distributed. Think of it as a tax-deductible charitable savings account. Number 6. Offshore accounts and tax havens. Through international trusts and offshore companies, some wealthy individuals defer or reduce taxes using favorable laws in other countries. This is legal when reported properly. Illegally hiding assets is tax evasion. Number 7. Cost segregation in real estate. This is a tax strategy where a real estate investor accelerates depreciation by separating building components like windows, wiring, for faster tax benefits. Break down a building into parts. Each part depreciates at different speeds, increasing short-term deductions. 8. Maximizing business deductions. From office space to software and even home offices, wealthy business owners write off everything they can under Section 179 and other provisions. Track 1 month of expenses. How many of them could be reclassified as business-related if you owned an LLC? 9. 1031 exchange, deferring real estate tax. This allows real estate investors to sell one property and reinvest in another without paying taxes immediately on the gain. Like trading an old car for a new one without paying tax on the car sale. 10. Family employment and income shifting. Wealthy families legally pay their children, e.g. through a business, shifting income into lower tax brackets. Pay your teen $12,000 a year to do marketing. You reduce taxable income, and they likely pay no tax due to standard deduction. 11. Health reimbursement arrangements, HRAs. Wealthy small business owners create HRAs to reimburse personal medical expenses tax-free. You pay for a family member's surgery through your business plan and deduct it, rather than paying out of pocket. 12. Step up in basis, passing on wealth tax-free. When someone inherits an asset, the value steps up to current market price, eliminating capital gains taxes on past appreciation. Dad buys a stock at $10. At death, it's $100. If inherited, the tax is based on $100, not $10. The $90 gain disappears. 13. Roth IRA conversions. Backdoor Roths. High earners bypass income limits by contributing to a traditional IRA, then converting to a Roth IRA, avoiding taxes on future growth. It's like sneaking money into a tax-free vault through a legal side door. 14. Using trusts for tax planning. Rich families use irrevocable trusts, charitable remainder trusts, and grantor retained annuity trusts, GRATs, to reduce estate taxes and income taxes over generations. What if your business income was split among 3 trust beneficiaries? Tax burden drops due to lower marginal brackets. 15. Harvesting tax losses. They sell losing investments to offset gains, then reinvest in similar assets. This is called tax loss harvesting. Stock A loses $5,000, sell it to offset gains from stock B, buy a similar ETF the next day, you lock in the loss but keep the exposure. These strategies aren't about cheating, they're about knowing the game. The rich don't avoid tax because they're lucky, but because they're strategic. Now that you know the 15 secrets, it's time to play smarter. Like, share, and subscribe to The Art of Building Wealth, and turn knowledge into power.